Hello, friends. Welcome to Nirmal Bang. Today, I am taking you to the conversation with on the mutual fund industry and also with an industry veteran who has seen the cycles, many years of cycle across equities, bonds. Let's remember the last year again was a special year for the markets. We see a huge volatility in the global markets. We saw large inflation. We saw rapid rise in interest rates. We also saw again sort of a tough period for the bond investors for a brief period of time. Equities weathered it, and now this year, as we step into FY24, we actually are seeing a very terrific combination of almost multiple asset classes performing at the same time. Gold has been outperforming. Bonds have started rallying. You actually have already seen 50, 60 basis point rally in the 10-year benchmark so far over the last many weeks. And then you also actually are seeing equities still producing a good sort of positive returns. So perhaps now, if you're making a strategy for FY24, perhaps it's prudent to really hear from our experts on how, as an institution where they're managing so much large of AUMs, how they are thinking, what they are strategizing. And now, for hearing that, let me now welcome the Managing Director and CEO of Mahindra Manulife Mutual Fund, Mr. Anthony Heredia. Sir, welcome to the show.
Thank you, Piyush. Very glad to be here.
Sir, I would like to start with the very basic question for our viewers, and I think many of them would be actually thinking, and they would be hearing a lot right now about new debt funds or about how basically interest rates are at a cyclical high. They should lock in the interest rates. These rates perhaps would not be available to them next year. Perhaps bonds actually would be looking good. And then there is a sort of typical Indian attraction of gold, so much of returns in the last 1 year. And there's so much of distraction for our viewers, an average viewer who would be just thinking to make some returns. How you actually are looking at overall asset classes right now?
So, Piyush, I think your opening comments are very valid. So, let me put it this way. I would prefer to structure my answer in two parts. There's an investor who's looking at how do I invest for the next, let's say, 1 to 2.5 years. And there is a long-term investor who has long-term goals and says, where do I invest for the next 5, 7, 10 years? If I think about the investor who is looking at, let's say, a shorter time frame, over the last decade or 2 decades, there are only some points in time where you get a large amount of conviction that rates are eventually going to start easing off. And history will tell you that if you are starting to invest at the beginning of that cycle where rates start coming off, over a 2 or 3 year time frame, even if you think that the 10-year benchmark is 7%, the opportunity to actually deliver a return which is actually close to double digit, the probability just goes that much higher. And I think we are in that sweet spot. It's not as if we have been in that sweet spot only in the last month. I think we've been calling out to our clients pretty much since December of last year that we believe that rates are peaking. It's a matter of time. Let's not obsess about whether the 10-year at 740 is a good buy. It may go to 8. Use an equity kind of lens typically. Buy low, sell high. And that was clearly the opportunity that debt to our mind was giving and continues to give. So my answer would be that for an investor who has a 2-3 year time frame, I think at this juncture, probably bonds goes over equity from a risk return kind of perspective. But if you go to a slightly more longer term perspective, let's say 5, 7, 10 years, then I think the India opportunity is just incredible, right? And I would just frame that in, we can debate sectors, overweights, underweights, we can debate market valuations, etc. But to my mind, there is one very fundamental thing, which is if you think that India has all the ingredients to become the world's third largest economy in the next 5 to 7 years, and you think about what kind of GDP that represents, and you just do the historical maths, what is market cap to GDP's historically been, etc., you can then kind of clearly look at perhaps doubling or more than doubling of your money over the next 5, 7 years from equity. I don't think the journey is going to be particularly smooth, which is why I kind of said to the investor who has a shorter time frame, I think equity I would advise with a pinch of salt. But for the investor who has a 5-7 year time frame, I would say don't lose the opportunity to allocate your fixed income allocations right now. Make sure you complete whatever fixed income allocations you have to make. This is the perfect time. And then focus on making sure your longer term investments in equity are done, and don't worry about whether the Nifty is hitting all-time high this month or we have a 5% correction next month. 7 years from now, it won't matter.
Right. So let me first put up my question on the bond yields here. We are talking about almost 6.5, 7%, like wherever it goes. When was this, the last similar sort of start of the cycle you saw? Like how many years back?
No, so we obviously saw that in 2000. I mean, to me, the most the biggest memory, and I'm saying this because we also have a situation where global factors are very critical, right? So to me, there will always be many points in time where interest rate cycles have peaked and come off. But I'd like to reference two. You look at 2008-9 financial crisis, you look at 2013-14 balance of payment crisis, right? And I remember people saying that our currency was under pressure. 10 year was at 8.5. People said it will go to 9.5. But people who believed that things would actually normalize, and this was the peak of where rates were going to go, and things would only normalize from now, effectively made serious money over the next 3 years. So I'm saying it from the same perspective, right? Think about the last 12 months. What is the narrative? We have a war in Russia, Ukraine. We have how is the Fed tightening going to impact global markets? How is the US interest rates, which are unprecedented in terms of absolute value, etc., 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 right? And I think today we are in a situation where we are saying we are potentially starting to see inflation cooling off. We are starting to see commodity prices come in much lower. We are starting to see crude ease off. We are starting to see the US understand that there are implications of increasing rates at a fast pace in terms of the regional bank situation. So they probably will not pause, but they will certainly not be as aggressive. So I'm arguing that basically what is happening, situation is normalizing, right? And therefore, if you go by history, you go by 2009, you go by 2014, when the situation normalizes, the next 2.5 years tends to be a fairly sweet spot for the returns you get from bond. And I'm reasonably confident it will happen again.
Right, sir. And I think let's remind our viewers that when you're talking about almost bonds, like let's say 10-year bonds around 7%, then you're adding capital appreciation, because as the yields go down, the bonds start rallying. And that's why actually sir is saying that perhaps double-digit bond returns are not ruled out, looking at the historical sort of experience. So perhaps when we look at a strong possibility of 10-year giving us double-digit returns over a 2-year, 3-year period, from that perspective, and as you know, by the grace of technology, we have started seeing corporate bonds also now available very easily for the retail investors. We are seeing a lot of variety of tenors now for the investors. Looking at the way Mahindra Mutual Fund would be investing across the debt mutual funds, right now, what it is looking more attractive across the mutual funds? Is it the longer tenor? Is it the corporate bonds? Is it the shorter tenor? Or right now we're at the start of the cycle, so longer tenor, and then maybe 7-8 months down the line, more shorter tenor. Like how our viewers should really sort of look at the funds.
So I would put it this way, and this is what we're doing. We've been doing this for the last 6 or 9 months. There is one unusual situation that has taken place over the last 1 year, which is, there are a large number of target maturity funds, those kind of products, which has meant that the spread of corporate bonds over government securities is at a decade low,
Yes,
right?
yes.
So even if I was to get the interest rate call right, I think the spreads will go back to normalcy as well, and which is why we are going long, but we are principally sticking to either the government bonds or we are sticking to extremely high quality credit. That's not to say that we believe there's a credit situation. We're just saying that given the spreads being so narrow, you're not getting paid for the extra risk. We think that the way to play it maybe would be longer tenured, more government bond oriented now, Perhaps 6 months from now, if spreads start to widen like they should, then get into corporate bonds, again longer tenure. And when you start seeing the rate cycle genuinely peaking out or playing out rather, then perhaps start to go shorter. I don't think the game is going to be only of the next 6 months to a year, where you're long at the start of the financial year and you've already gone short at the end of the next financial. I think starting to go short is then related to saying, I think interest rates will now go up. I don't think that's happening in the next 12 to 24 months. The next 12 to 24 months will be interest rates easing and remaining stable. And so for investors, I would say staying long and being in government bonds to start with, or related to government bonds, extremely high quality AAA credit, and then maybe moving down that credit curve when spreads are in your favor is the way to go.
Well, for our viewers, again, if you're absolutely passionate about debt investing, you got your best answer. Dynamic funds, target maturity, how the sort of 1.5 year strategy is looking like. Now, let's switch to equities here. We're talking about almost sort of nominal returns around 11%. If you add inflation to the GDP growth, the nominal growth around 11%. Equities, again, if we sort of take a look from the perspective of earnings growth expectation on the index, at least we're talking about 13 to 16% earnings growth. Under this circumstance, according to you, because as an industrial, as a mutual fund house, you would be taking a call where actually you should be really now focusing more large caps, mid caps, small caps. I'll try to class small caps with mid caps, but between large caps and mid caps, where we are right now, sir?
So let me just take a step back for a moment. Right, we're probably about a month back. What was our narrative? That markets have had a time correction. We have seen virtually 0% return for last 18 months, right? And in certain capitalizations, they have been negative. Uh, Almost a month later, the story is slightly different because a difficult month has passed 18 months ago, and the month of April has been positive. If you think about it from a earnings perspective, I'll just make firstly a couple of comments on that, and then we can get into the relative attractiveness of mid and small versus large. I think if you look deeper into the numbers, the earnings growth in the last 18 to 24 months, as you would agree, has been extremely good. But
Yes.
the only negative I would point out is the breadth of those earnings has not been as good, right? The headline numbers have been met, but you look at the extent of contribution from just one part of the earnings sector contributors, which is banking and financial services, and that's been a complete outlier. And it's not difficult to understand why, right? Because effectively you have been in a rising interest rate environment. It is the lenders who have had sway, and so it is their balance sheets and their profit and loss accounts that have benefited. If you believe that we are moving into an interest rate cycle that has peaked out, I think the game moves from the lenders to the borrowers, right? But it will be a gradual journey. So I think potentially the earnings growth coming through at a headline level at 13-16% to me looks slightly challenging, because if
Okay.
bank NIMs kind of get under pressure because obviously interest rates are kind of coming off, you could see 13-16% perhaps look more like 10-12%. But as a fund house, I think the positive is the breadth will be better, because the like I said, the game is moving to the borrowers, and the borrowers are spread across a variety of sectors. Now within, so if you look at it from that perspective, I think small caps, and I will differentiate small from mid, because frankly, from a valuation perspective, there is a gap, right? We
Yes.
often club small and mids together, but I
I,
would
I'm
really,
that's why you're picking it out.
yeah,
Please proceed.
I mean, yeah, so I would say that actually, in order of valuation comfort, it is small, followed by large, followed by mid cap.
That's
If you
interesting.
if you
That's
if you
interesting.
look,
And why are you thinking like that?
if you just look at pure forward earnings estimates at this point, and then you see what people sometimes do is they will compare large cap valuations with mid cap valuations. But I've always believed that the right thing to do is actually compare it relatively to what they themselves were over a 5 year period. So if you look at it, large cap is probably trading maybe one standard deviation over last 5 year average. Small is trading perhaps just under 5-year average. Mid is actually trading over the average, right? So if I was to look at that as a yardstick, then I would say certainly small over mid and large. Number one. Number two, look at a theme that has played out for small caps over the last 2 decades, right? Effectively, small caps do well when interest rate cycles are in their favor. So if you have deep conviction that rate cycle is going to be of easing in the next 18 to 24 months, you would tend to believe that small cap earnings growth will therefore be that much better. And if you combine that with the fact that valuations are in, from a relative standpoint, more comfortable, I would say small caps clearly make sense. And it's shown in the market, right? I mean, if you look at mutual fund flows, for example, for the last 5 or 6 months, virtually 50% of the flows are coming in mid and small cap. I think they're coming for two different reasons. They're coming in mid cap because the last 1 year return is looking better than all the other capitalizations. And it is coming in small cap because people see a lot of relative valuation strength. Looking over the next 1 or 2 years, I would say rather than getting into, we have this slide, I can send it to you later. We have this slide which basically looks at cap, mid cap, small cap over 5, 7, 10 year time frames. You discover that, beyond the point we are spending too much time debating this topic. Eventually, and this is the title of our slide, Sabka time aayega, right? So effectively, that's the beauty of the market. So I would basically tell investors that perhaps just look at multi-cap or flexi-cap funds. Let the fund managers figure out which part of the market looks good. In any case, we have a view that this is not so much a top-down market; it's a bit of a stock picker market. So eventually, what kind of if I'm, let's say, going to take a view on technology, that is quite natural that the large cap bias of my portfolio will tilt upwards. Conversely, if I believe cap goods is a great story, it's very natural that small caps will be a large proportion. So I wouldn't think about it as much in small, mid, large terms. I would just probably look at it in saying, go with a multi-cap fund, go with a flexi-cap fund, let the fund manager make the call in terms of the companies they will buy in the portfolio rather than the sectors they will weigh.
Right. In fact, you have already answered my next question. So multi-cap perhaps is something a great idea. And I was actually looking at your multi-cap fund, and I was clearly seeing that banks actually are forming around 11% of the holdings. Then you actually have IT stocks around 5-6%. Then again, you have capital goods forming another 5%, a bit of pharma 4%, a bit of telecom. Uh, very very well spread out. But it's nicely sort of diversified. But when I look at what happened in the last year, I see strong performance from capital goods stocks. I see good rally in the banking stocks. You've already sort of referred to that. Then I also actually see that FMCG, maybe because of inflation, the nominal growth really looks very strong. These actually have rallied, outperformed. Who do you think actually could be the sector leaders? Or I would say, in terms of sector, which sectors could lead the sort of next leg over the next 12 months?
So I'll make a broader comment, Piyush. I think one aspect that one has seen in markets, at least over the last 18 to 24 months, has been it's a bit of a value biased market, right? So growth sectors, growth stocks haven't done as well relative to the more perceived value sectors. We firstly think that if you are in an environment where you believe rates are going to come off, if you believe commodity prices have softened, if you believe inflation is under control, uh, then even though the last 1 year has been a space where what you refer to cap goods, auto, FMCG have performed well, we would still believe that that has legs to run, right? Because you look at consumer discretionary, for example, the moment interest rate cycle has peaked and effectively EMIs stay where they are or they actually start to come down, there's an automatic implication for consumer discretionary spend. And that's obviously not just related to auto, it's related to media, it's related to a lot of other discretionary. So we think consumption is still interesting. And in fact, if you look at our portfolios, that's actually been a marginal underweight. That's probably the one sector we will now start to probably overweight a bit because commodity prices also are coming off. Uh, I think IT and pharma will still be a wait and watch for us. We are underweight marginally. If valuations become attractive, then you get into those sectors in a bigger way. But as a business perspective is concerned, I think it still remains capital goods, building materials, that kind of area, consumption, banking and financial services. I would just caveat, and I think it will see the return of private banks. I think for a lot of the public sector banks, they do benefit when the rate cycle peaks upwards, and economic cycle is good, so NPS kind of come off. I think we will see a situation where, I know you typically look at banks as a price to book story, but I think there's a bit of a PE thing that you think about as well, especially with the privates. So I think those are what we would see as forming bulk of the portfolio. But I'm reiterating, I think this is not a market where you can make any strong sectoral calls. I think it's a market where you've got to go stock by stock. There are opportunities for, let's say, a stock in financial services. It may not be the same opportunity for another stock in financial services. So that's the way we'll kind of construct, at least for the next 1-2 years.
But would you believe that you'll start looking at PSU banks more constructively? I was just trying to figure out in what you were referring to. Because private banks, I can assume that the sort of the position where they are, they will remain like that. But PSU banks, which is largely missing about just except one bank, is it something where you look with interest?
I think when I talk to my fund managers, I think the sense I do get is that they're still more comfortable with the private banking side. So
Yes.
they're I mean, we participated in PSU banks over the last 1 year, but the some of those that space particularly has done really really well, right, in the last 1 year. To some degree, I would say the valuation comfort that one would have had 1 year ago, you don't have that valuation comfort as much now. And then with some of the headline private sector banks, where you would have actually had perhaps some valuation discomfort a year back, you probably have better valuation comfort now. So I would still believe private sector banks will dominate. I will just call out, it's not something that I think is ripe for investing at this juncture, but I think you could see the comeback of NBFCs as well, right?
Okay.
Because there are opportunities within certain spaces that where historically NBFCs do well, because NBFCs also do benefit when rate cycle is a little easier, helps
Yeah.
them from a borrowing cost perspective, etc. So I think that part will come through. I think within financial services, asset management and insurance is still probably a neutral situation.
Yeah, and that's something I think which also is missing. I was just going through the fund, and for our viewers, I was just trying to think around from a consumption perspective. Very clear that you're not overweight on staples because we don't see that in your funds. You are looking at discretionary space, and there are numerous examples for that. There are good sort of very brands which are well known over the last many decades, and different types of from food consumption to sort of discretionary consumption. Uh, Staples, consumer staples, is that something which you think could look interesting as sort of consumption more revised or valuation is an issue?
So, Piyush, as you are aware, staples, especially the kind of the headline names in that space, have historically always traded at fairly handsome valuations, right? So
Yes, yes.
if you have to go into a serious overweight, you need to have very deep conviction on two things: either that base consumption demand is going to pick up in a very big way. And if you actually think about it, that has already taken place post COVID. So a lot of that pent up demand is now done. Now it's back to normalcy. So you don't necessarily see demand coming through any stronger than otherwise. If demand has to come through, it will probably come through on discretionary. But one thing that we're watching very closely, and that could lead to creating some overweight, is commodity prices softening further, because
Okay.
that is a very significant part for a lot of these companies in terms of costs, right? And so they may end up then surprising on the upside in terms of margins. And we're probably looking at, like we put it this way, between consumer discretionary for us is probably a more top line play, while consumer staples to our mind is probably more of a bottom line play because margins improve due to softer commodity prices. We are a lot more interested in staples, let me put it this way, today than we were 6 or 9 months ago.
Okay. I want to ask one question out of my interest. Uh, for our viewers who would be looking at Mahindra mutual funds across equity categories, what is sort of core philosophy here? And I'm asking one question, one example, but that example could be generalized. Like, for example, there are no tourism stocks, hotels have done well, there are no hotels there. NBFCs could have been related to cycles. So, is it more about the sort of long term performance, long term sort of modes? Like, what sort of philosophy runs deep across mutual funds for our viewers to understand how the Mahindra mutual fund really works?
Yeah. So, in a lighter vein, Piyush, I will tell you that you can boil down every fund company's investment philosophy, which there are lots of very fancy acronyms. In our case, it is GCMB, but effectively every fund manager effectively tries to buy a company that will grow at a reasonable valuation. Mota moti, that is the call. If you ask me, what is it something that distinguishes us, and I think we are quite obsessed about catalysts. So yes, there is growth, yes, there is valuation, but we often get either positive about a company or negative about a business that is changing the landscape, right? So that is what I would probably distinguish as perhaps something that you will see as a differentiator for us. Like I said, you take the example that we just spoke about, our staples, right? If commodity prices, oil, etc., keep coming off, to us, that's a catalyst for a significant change in the margin profile of consumer staple companies. And we would
Yes.
need that catalyst to take place rather than just simplistically looking at it as a demand and a valuation story. So I would say focusing on that, PLI is another great example, right? I mean, PLI has been a very significant catalyst for a number of companies, and in general for Indian manufacturing as a whole, right? So that I would say would probably distinguish the way we think about it. That if you are able to spot a couple of catalysts ahead of the market, over 3-5 years you will tend to outperform the market. That's the way we kind of work on it. The philosophy, yes, growth, cash flow, management, valuation, but point is that's the basics that everybody should look at anyways when investing, right?
Well, absolutely. And that brings us to the end of this conversation. Our viewers definitely would have actually gained a lot from the perspective of bonds, what they should be choosing. Small caps should be of interest to them, as you just highlighted. Small caps sector is actually trading at low valuations versus mid caps, small caps, large caps, and then mid caps. That perhaps should be something interesting. Multi cap funds, they should be actually sort of looking at with great interest. As a fund managers, they take the bulk of the load in terms of analyzing it, and overall it's all about sort of really focusing on the sort of quality of the picks here. So sir, thanks a lot for coming on our show and giving all your knowledge to our viewers.
Thank you so much, Piyush. It was a pleasure being with you.
And with that, dear viewers, it's a wrap on the show. Hope you enjoyed it.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.